Folks, this is the Contrarian Trader. This is a day of significant events, and I'm going to get to the charts in a moment. But what I want you to listen to first is what you get when you cross a liberal CNBC commentator with an economist. Check this out.
The only thing keeping the economy together is $85 billion a month of bond purchases. We're in bad shape.
Yeah, but that doesn't argue for not doing it. I mean, that's a little bit crazy, isn't it? No offense, of course, but if it is the thing keeping the economy together at a time when the government is reducing its deficit, and one of the things the Fed is doing.
You're kicking the can down the road, Steve. You got to get out sooner or later.
Sooner or later, you got to take your lumps.
Don't you got to take your lumps sooner or later?
What would taking your lumps mean? You're saying that the Fed
clear the system.
See, the Fed takes
let the economy stand on its own. Clear the system.
Well, why would that clear the system? In other words, what are you talking about? You would get rid of...
Because if it's not, if it's always ahead of you to get out of it.
It's been so long they don't even remember, Joe.
Where's the hurt? What are they doing?
Maybe it'd hurt more later.
What would hurt
the
more
problem is
if you stay too long.
It's at best curing the effects. It's not curing the problem.
But when we talk about not curing the problem, what would the Fed withdrawing...
Maybe it would make
what would that help?
Maybe it would.
It isn't that so much. But if we think that's a permanent solution, and we know it's not,
I'm the one that wants to do this forever.
I know you are.
I just want to.
Okay, that Steve Leisman is just an absolute moron. And you heard it there. Structural reforms. That means that Washington needs to change tax policy, spending policy, but they refuse to do it. They don't want to do their jobs because they want to get reelected. They don't want to make the hard decisions because Bernanke is supporting them. He is subsidizing them in their jobs. He's doing a horrible job. And I'm going to get to a chart of the housing sector in a moment that should enrage you. You as the American consumer are getting screwed. The American taxpayer is getting screwed. And I'm going to get to that in a moment. But real quick, check out the chart of the 2-month cumulative change in average new home price. New home price. It's the largest 2-month decline in new home prices since Lehman Brothers, and the largest 2-month decline in history. And this is on the heels of $85 billion worth of bond purchases. Let's get to the charts. It's crazy. All right, Dow Industrials on a daily basis. Down today, well, check out your money flow right here. Money flow. Looks like it's putting in a double top. And watch for a breakdown right below the support level. It's not going to be pretty if we get a breakdown. Volume was fairly low. Dow Industrials weekly chart, topping action. Just above the 15.5 level. We're holding on to it. But I'm going to get to a chart in a moment that should scare you, those who especially believe in the Dow theory. Subscribers to the Dow theory believe that when the Dow Jones hits new highs, so should the transports be confirming. What are we seeing this week so far in the transports? We're seeing virtually a bearish engulfing of last week's move. It's still only after the close on Wednesday, 2 trading days to go, could all reverse itself. However, keep this chart in mind as we proceed into the back end of the week. Weekly chart, MACD, look at it. It's going to fail. It looks like it wants to fail. Try to do a head fake to go positive, it's going to fail. S&P 500 daily chart, holding at 1680. Everybody wants 1700. They still may get it. Down for the second consecutive day on rising volume. Finally, we got some average volume to the downside. Yes, I like the short side of this market, as you might be able to tell. IWM daily chart, nice candlestick, second down day in a row with rising down volume, but frankly, I'm not all that impressed with the down volume day. I mean, look at it. It's well below average. For me to get excited, I need to see a spike in volume to the downside. And Lord knows, with earnings season the way it's been, we certainly deserve it. Semiconductors. This is a weekly chart. You could see what a horrible week we're having. This is a sector that looked really good 2 weeks ago. Now we're down over a percentage point, over almost a percentage point and a half on the week. Sloppy action here. This MACD weekly chart, I've warned about this. They try to make it move higher as soon as they get your confidence. It's a bull trap. They want people to get ahead of this move higher. These MACD followers, sure enough, once they buy, they dump. XLU, the utilities. This is our canary in the coal mine for interest rates. And we know that the XLU trades inversely to interest rates. This is why I always keep overlaid my 10-year bond yield, down 1.37% this week. And here's your yield, trying to spike back up. I'm going to get to a chart of the yield in a moment. So I would avoid the utilities. The housing sector. I mentioned this. You can go back on my video from one of my videos from last week. I mentioned a couple of times the housing index. This is the HGX. You can pull it up on your chart. This candlestick here is the Bernanke rally. From 210 down to 168 is a 20% correction in the housing sector. Now remember, $85 billion per month in bond purchases to keep this rally going. And it's failing. And I mentioned last week that if this sector breaks down below this prior resistance level and back into this channel, you're going to put at risk this 168 level, which if it breaks down below the 168 level, would put us in Wall Street's definition of a bear market on the housing sector. Remember the chart I showed you at the very beginning. 2 consecutive down months, the biggest since Lehman, the largest in history these past 2 months in new home prices. Watch out for your home builders. 50-day moving average, hooking down below. It's going to act as a declining ceiling. If this breaks down below 168, new bear market in the housing sector, and Bernanke should be fired. The VIX key reversal this week. This is a weekly chart and is now trading back above support. 30-year bond price, not the yield, but the price of the bond. And you could see we had a couple of weeks, really, scratch that. We had a couple of weeks of a relief rally on Bernanke's testimony, whacked dead at the 134.96 level. Key reversal, bearish engulfing, a close today on a weekly basis below the 200 period moving average. Technically significant. Housing recovery, huh? 10-year bond yield. I've mentioned this for weeks now. We are going to see 3% on the 10-year Treasury bond yield. Any idea what that's going to do to interest rates? What that's going to do to those people that want to, with limited income, who can afford to buy a house, are going to get pushed out of the fixed mortgage arena and pushed into the adjustable rate mortgage arena, which got us into this mess in the first place, and it's at the highest in a few years now, those new mortgage applications. Adjustable rate mortgages once again. Keep an eye on this. It's been flirting with the 50-period moving average on a weekly basis. I mentioned to members that it's going to be resistance. Don't listen to the pundits saying that it's the Federal Reserve knocking down rates. Rates are going higher. There's inflation in this economy. I think that eventually the markets are going to tell Bernanke by way of inflation, you're going to have to pull back on your bond purchases. Inflation is getting out of control, and rates will probably sniff it out and lead the way higher. Apple. I've been bearish on Apple for quite some time. I am now becoming far more constructive on Apple. I am getting bullish on it. I like the setup here. Double bottom setup on the neutral level here on RSI. Good volume today after earnings. I think we could begin to nibble on Apple, accumulate, use a trailing stop loss order, and add on strength. You don't have to jump in all at once. There's a lot of backing and filling to be done here. However, the 50-day moving average is flattening out. I will be sending out alerts to members. And that's it, folks. Enjoy the remainder of your evening, and I will talk to you tomorrow. If you have any questions, please shoot me an email. Robert@thecontrariantrader.com.